Hey everybody, it's time for this month's safe investing update. We've had a little bit of tweaking and changing since the new year began, so let's jump right in. When we look at the corporate bond world, our yield to maturities we should be looking for in the safe side of things should be in the 5s, maybe in the 4s if you're looking for the shorter term duration. So 4 or 5%, you can get that pretty easily out there in the corporate bond. Remember, this is yield to maturity. That's what matters. It doesn't matter what the coupon is. You can have a 1% coupon, but a yield to maturity of 5% because you bought it at a really big discount, okay? The other thing I want you to notice, look at the Bs. Corporate triple Bs, even municipal triple Bs, but the big one is corporate triple Bs. Look how much higher they are, 7s. They're really showing the risk. That's what we see. When we look at these rates and we know what's going on behind the scenes, there's over 30% of bonds piling up in that triple B range right there on the edge of becoming junk bonds. And that's when you're going to get hit real hard. If that bond gets downgraded into junk bond status, the value of that bond will plummet, okay? So the corporate bond world, we're looking at 4 or 5% in the fixed kind of safer world that we're looking at. But every time they raise interest rates, you're going to lose value in that bond. So if you're retired, if you're living on a fixed income, using these as a safe investment, probably not the greatest idea. We're not done raising interest rates and we don't know how far they'll push them. So we do need to understand the general concept: as interest rates rise, the value of bonds goes down. So we want to stay away from bonds. We haven't stopped pushing interest rates higher. If we got back to 10, 12% interest rates, sure, you want to lock into some longer term 20, 30-year fixed interest rates with bonds, that's fine. Nothing wrong with that. But trying to think that right now we're at the highest interest rates, it's been a nice little run. We've got much more respectable interest rates, but in the grand scheme of things, we're extremely low. Look at our previous videos on the safe investing. You'll see the charts of the US interest rates. Then we got treasuries. They're kind of useful, actually. Believe it or not, it's been a while. So the useful ones, Treasury bills. If you just need some short-term place to stock away some money. I had a client that sold their house and they needed to stock it away for a few months because they're not going to buy a house for a few more months. And they're just going to turn around and then use that money. Well, Treasury bills are for the shortest term, okay? We're looking at weeks, 4 weeks, 13 weeks, 26 weeks. 52 weeks. And if you notice those interest rates, when you look at the rates on this, they're all about 4.5%, whether it's 4 weeks or 52 weeks. 4 weeks is really short, so that one's 3 point something. But regardless, if you just need a real quick short-term place to stock it away, treasuries, why not? Well, I will tell you that that's a little less than what they're paying in money market accounts. I saw a 4% money market account out there, which is a FDIC insured bank account. So maybe that's an easier way to do it, but hey, 4.5%, pretty respectable for weeks. Then if you have a little bit longer to wait, bills. Bills are the years, 2 years, 3 years, 5 years, 7 years. Well, you get paid less. The further you go out, the less you're going to get paid. You know what's funny is look at that 2-year compared to the 10-year. How does that make any sense? 4.3% to invest your money, 2 years with zero risk, right? It's the Treasury. That's as no risk gets. 10-year is only paying 3.625. Okay, that's a long ways off. We are very upside down on our interest rates. This is called an inverted yield curve. Doesn't usually end well when we have an inverted yield curve, but we're in strange economic times. This is different. We're in uncharted territories. And so we're supposed to have a really terrible recession right now. And behind the scenes, there are some bad economic numbers coming out, but we seem to be marching right along. The other one that gets a lot of talk right now is the I-bonds. The I-bonds are interesting because every time we see a jump in inflation, the feds come out and say, oh, we're paying 9%. Well, come on, really? So first of all, you can only put $10,000 in I-bonds per social security number, okay, per year. So it's not really a portfolio allocation that you can actually utilize. The other side of this is there's a penalty if you try to redeem these within 5 years. Anything past 5 years where you can redeem them anytime. And the other part of this is how they calculate that. So if, let's say, the consumer price index change was 9%, relatively close to the last couple of years of this. So let's say it's 9%. Change 9%. The feds come out and say, we're paying 9% interest for the next 6 months. Well, that really means they're paying 4.5% for 6 months, just so we're clear. That 9% is an annual representation, okay? But the other thing you have to know is that it is the change of the consumer price index urban, which is a different mix than the standard consumer price index. It's the change in the index, which means, yes, they can pay negative interest. So be careful with these. They're not the greatest thing ever. Just because they pay 9% for 6 months, which is really 4.5%, then they recalculate, it could be negative, okay? So just be careful with these things. They're wonderful for a minute. That's about it. And you can only put 10,000 in. So they don't really fix any safe investing strategies that you're really looking for. All right. CDs with insurance companies, MYGAs, multi-year guarantee annuities. In another month or so, I have my class on understanding annuities. And so I'll put out a whole bunch of videos on different types of annuities and really kind of dig into some of these. But you have to understand that these insurance companies created these to compete with CDs back in the 70s and 80s. Okay. These are a fixed interest rate with a fixed period of time. So 2-year, 3-year, 4-year, all the way to 10-year. And the interest rate you see next to it is the fixed guaranteed interest rate for that period. It's very simple. You put money in, it grows by that interest rate. The difference between these and CDs is pretty cool, okay? This is where all the stigma of the word annuity, all the dinner seminars and sleazy salesmen and all that stuff does not apply to this. Most of these are sold at banks. Anybody with an insurance license can do these. Unfortunately, they don't pay the big commissions, so you don't see them everywhere. Nobody wants to sell them because they just don't pay a big enough commission. Okay, so here's the difference between the CDs. Tax-deferred compound interest. Make sure we heard that. Most CDs are simple interest, and you have to pay taxes on that interest. These mostly are, well, they're all tax deferred, mostly are compound interest, especially over 5 years or so. That's a huge difference in the amount of interest because you're earning interest on top of interest daily. You're also going to get 10% penalty-free access in most of these. Okay, that's why we don't need to do 6 week, 6 month, 6 year, whatever, 1 year CDs. We don't need those short-term CDs. We can put money in here and pull money out when we need it. As long as we stay within 10% of the value of the account each year, we're fine. There's no penalties. You're living within the rules. They're able to invest it so they can pay you this interest and everybody's happy. So don't put your last penny in here. Make sure you understand you're only going to have access to 10% of this money. For a lot of people, that works out well, especially in an IRA. There's no problem putting these in an IRA. Okay, no problems at all. And you can pull a required distribution out of these. You can pull up to 10% with no penalty, and your required distribution isn't hitting till 10% until your mid-90s. And all these contracts say they're required minimum distribution friendly. They will never penalize you for that distribution. Obviously, higher rates in CDs, you're not going to find interest rates like this in CDs. In typical, you're going to see 5, 7, and 10, but because the banks have been selling them during the low interest rates, 2, 3, and 4% have popped up, okay? Usually the sweet spot is 5 years. There happens to be a 0.05% better option out there at 6 years and a 0.1% option better at 7 years. That isn't normally like that. Normally for the last several years, the 5 years been the best. And again, no risk, no fees. The commission is paid by the insurance company, and it's a tiny commission. Just, hey, thanks for the business. Here you go. And that's why most of the advisors won't write these for you, because it's too small of a commission. How are they supposed to make money? Okay. But understand, no fees to you, no risk. These are great. There's nothing wrong with these. You put these up against any CD, any bond, you're going to pick these things first. And then the last one is fixed indexed annuities. I talk a lot about these. I'm not a big fan of putting a lot of money in just flat fixed rates when we're in a fluctuating interest rate environment, right? Because what if you go and get 5% right now, and next year they're 7%, and the next year they're 9%, the next year they're 12%, and you're stuck at 5%. That's how you're going to fall behind inflation numbers. That's how you're going to fall behind. And so, yes, some fixed rate, that's perfectly fine. But when you're creating a portfolio, you don't want to weigh too heavily on just flat fixed rates like that. Okay, so fixed indexed helps out a lot. You're still going to get a fixed rate option. In one investment, you're going to have several different ways to earn interest. So in this example here, this is one of my favorite safe investments that honestly I've ever seen. So it's a 3.5% fixed rate. You can get 5% and 5.5% on a fixed rate if that's all you want. Okay, this one gives you 3.5 as a fixed rate option. Okay, so that way you can change how you earn interest each year. And so when we're in years like this where the market's just not looking good and we don't think it's going to be up a year from now, we can just sit back and earn 3.5%. Think of it as a 1-year interest rate. Okay, they also give you indexing options. Okay, so this is one investment with several ways to earn interest. And when I say indexing options, basically we can allocate money to each one of these, all these little arrows here. There's 3 different stock indices and 2 different calculations, 2 different math. One's a 1-year, one's a 2-year. Okay, so we throw out the 2 years for making this simpler. And you look at the 1 years, the Morgan Stanley Dynamic US Equities Stock Index. Okay. And what you'll notice here is they'll pay you 110% of whatever that stock index does for the next year. Okay, anniversary to anniversary. They don't care what happens in between, anniversary to anniversary. If it was up 10%, then they have to pay you 11% because they're going to pay you 110% of whatever it does. Okay, that's the cool thing about this. And look at the returns. The last 10 years, that's averaged an annual compound rate of return of 11.83%. And that's obviously the best 10-year period. The worst 10-year period was 9.72. That's pretty darn good all by itself. Okay. The Standard & Poor's has a multi-asset index. They'll pay you 155% of whatever that stock index does. That's not averaging nearly as good as the Morgan Stanley has. But you can look at the best year and it's very comparable, 11.06 versus 11.83. And then the SG Intelligente Agile Index, another fancy index, they'll pay you 135%. But you can see the returns on this is pretty fantastic. When the market goes down, you earn nothing. You have zero risk. By regulation, fixed indexed annuities have no risk. So maybe this year you put 60% in the fixed rate and 40% in the Morgan Stanley index. A year from now, the market's down, 40% of your money didn't earn anything, but 60% of your money earned the 3.5%. And then things are feeling better. Maybe you put all your money in the Morgan Stanley and all of a sudden it's up and they have to pay you 12%. That's what these things really actually do. And sometimes that sounds too good to be true, but when you understand what's going on behind the scenes and how these insurance companies are doing it, it starts making sense. That's the important part about this is this isn't necessarily too good to be true. The cool thing that has changed in this world, because these have been around since the 90s. These have been around, believe it or not, now almost 30 years. Okay. It's kind of funny. This I've never seen. The participation rates are guaranteed through the entire period of the contract. So 5 or 10 years, they're guaranteeing these participation rates and that fixed rate. Interest rates could plummet back down to 0 and they still have to pay you 3.5. And these participation rates on these indices still hold true. That's what's really wonderful about this contract is they can't change this stuff. In all the years past, all the old contracts, all of them got to change their interest rates every single year. Now they don't. That's pretty fantastic. In the contract, these are as good through the whole period. At the end of the surrender charge period, either 5 years or 10 years, boom, you can move the money anywhere you want. So the cool thing is the flexibility you get. You can change how you earn interest each year. Every year you can move it around if you want. 10% penalty-free access. Okay, that gives us as people in retirement, we want the ability to pull our money out and actually use it. But we have to be realistic. We're not going to wake up and pull all our money out and spend it on one day, right? We have too many, fears that aren't realistic. If you wake up and have a big emergency and you have to spend every penny of it in one day, you're going to run out of money and be pretty miserable from then on out. So we don't really want to do that, right? You'll have 100% access, either 5 years or 10 years. Those are the two guaranteed rate products that are out there. Most offer 50 to 100% access if you go into a long-term care. So they start waiving the penalties and saying, hey, you can have access to it. That's really what they're doing for you. Death benefit, if you pass away, 100% of the account value goes to your heirs. No questions asked. Show me the death certificate. Beneficiaries are listed on the account. There is no probate, directly to the heirs, cash ready to go. Okay? There's no risk and no fees in these things. That's so important to understand. That's another one of those misconceptions out there on this word annuity. These things aren't typically sold in dinner seminars. They're selling you the fancy stuff with the fancy bells and whistles that nobody uses, that gets stuff sold with big bonuses and guaranteed 7%, 10% growth. They're doing stuff like that because they want you to distract you from the truth that that's really a high commission product. This is not that. This is simply a safe investment. It's an investment where you put money in, the insurance company gets to invest it however they want, and they have to pay you interest based on the contract. And the contract says they're going to pay you interest with all these different options here. And that is impressive. And this thing is doing extremely well. I have not seen a safe investment this good, honestly, in 30 years. This is pretty darn fantastic. Okay, and we're seeing a huge migration of IRA money, especially during required minimum distribution phase of life. This is the perfect investment for those IRAs. When you're pulling out regularly, certainly less than 10%, because it's all taxable. That's the last place you're going to need big chunks of money. You're not going to wake up and pull hundreds of thousands of dollars out of an IRA. That's going to kill you on taxes. You're just frittering your money away. You don't want to do that. So the restriction of 10% in your IRA shouldn't cause too many problems. And this is an ideal safe investment. All right, let us know if we can help out in any way. That's the quick review of what's going on in safe investments out there. If we can help in any way, give us a call, shoot us an email, share this with friends. Always happy to review all the different safe investments. Everybody has different needs, and everybody's portfolios are built a little differently. So we need to make sure that we've got the right things for the right people. And that's one of the big parts that I focus on, is making sure that we've got every safe investment out there at our fingertips, because we've got to pay attention to this market, because this is what's changing so much. The stock market, it's always up and down. It's not rapidly changing the way safe investments are right now with all these fluctuations in interest rates. So hope all is well. I will see you all soon. I have 2 more videos to create here for this week, and then I'll start working on next week. See you soon. Bye.